America can't afford dinner anymore. When Americans start rationing groceries, the economy has crossed a line that headline inflation numbers alone don't capture. A 1.8% drop in grocery unit sales in June compared to the same period last year is not a rounding error or a seasonal blip. It is behavioral evidence that prolonged inflation has finally ground down the financial resilience of enough households that people are physically putting fewer items in their carts. That is a different kind of signal than a survey about consumer sentiment. Surveys measure feelings. Unit sales measure decisions. The context makes the number more significant, not less. In June 2025, grocery unit sales were still growing slightly, up 0.1% year over year. The swing from modest growth to a 1.8% decline within 12 months reflects a household financial situation that deteriorated faster than the official inflation figures suggest. Grocery prices are now approximately 33% higher than they were 7 years ago. That accumulation is the critical detail that monthly CPI readings obscure. A 3% annual increase sounds manageable in isolation. 7 consecutive years of it produces a grocery bill that is one-third larger than it was when many household budgets were set, without a proportional increase in the wages funding those budgets. The Washington Post polling data sharpens the picture further. Two-thirds of American shoppers now describe groceries as unaffordable, a figure that jumped from 45% in February to 66% by mid-July. A 21 percentage point shift in perceived affordability in 5 months is not a gradual trend. It is a threshold moment, the point at which accumulated financial pressure crosses from background stress into active constraint on daily behavior. When two-thirds of a country's population says food is unaffordable, the conversation has moved well beyond the bounds of normal economic fluctuation. The coping strategies Americans are deploying reveal the depth of the pressure more honestly than any aggregate statistic. Couponing and deal hunting are the visible behaviors, the ones that show up in surveys and get covered sympathetically. The detail that stands out most starkly is the deployment of credit card rewards points, instruments most Americans accumulate with the expectation of using them for travel or experiences, to pay for groceries and gas. That behavioral shift represents a fundamental reordering of financial priorities. Vacation funds are being quietly liquidated to cover the weekly shop. The psychological impact of that reordering, the quiet erosion of the small aspirations that make financial stress bearable, is something no inflation index measures. The food industry is absorbing consequences that will compound over time. When unit sales fall, manufacturers face a choice between cutting prices to defend volume or protecting margins at the cost of market share. The private label shift is already underway. More shoppers substituting store brands for name brands is a structural headache for consumer packaged goods companies whose pricing power has defined their investment thesis for decades. Brands that built equity through decades of advertising and product positioning are now losing customers not to competitors but to price tags. The energy price trajectory adds the most troubling forward-looking dimension to this story. June's inflation data came in softer than expected, providing brief relief. But renewed tensions with Iran are expected to push energy prices higher in the coming months, and energy costs thread through the entire grocery supply chain. Fuel for transportation, inputs for fertilizer and packaging, operating costs for cold chain logistics. The grocery prices Americans are already finding unaffordable are not yet reflecting the next round of energy-driven cost increases working their way through the system. The deeper structural question this story raises is about the relationship between sustained inflation and social resilience. Economies can absorb a price shock. What they absorb less well is years of compounding price pressure against wages that haven't kept pace, eroding the financial buffer that allows households to absorb shocks without changing fundamental behavior. The 1.8% unit sales decline is evidence that buffer has been consumed for a meaningful share of American households. What replaces it? Further behavioral contraction, debt accumulation, or genuine wage driven recovery, will define the economic story of the next several years more consequentially than any single month's CPI reading.